Hi, and welcome to Forex webinar number 4, where we're going to look at fundamental analysis. For those of you who haven't seen my earlier Forex webinars, a little introduction. My name is Jelle Peters. I'm the writer of Forex for Ambitious Beginners, available in the Amazon store, both in paperback and for the Kindle. It's also available in other stores. I'm a writer for financial media, and I frequently give webinars and seminars on trading and Forex. If you have any questions about the book, because many of you have already bought it, simply go to forexforambitiousbeginners.com and I'll be happy to help. Okay, in this webinar, as said, we're going to look at what is fundamental analysis. We're going to look at the importance of financial news. We're going to look at some high impact economic news events, and we're going to look at how to trade the news, which is something many of you maybe already are doing. Or wanting to do, because it's quite exciting. Okay, so the definition of fundamental analysis is that it's the analysis of all the forces that influence the economy, such as production capacity, consumer confidence, employment figures, interest rates, etc. So basically it's very simple. There are a number of forces that influence the economy when factories start producing more, or less, when they start laying off people, when more people are finding jobs, which increases consumer confidence. All these factors impact the economy, and when the economy becomes stronger, the currency becomes stronger usually, and when the economy becomes weaker, the currency becomes weaker. Of course, it's not 100% of the case this is true, but most of the time this is how it works. So a fundamental analyst, what he does is he looks at the economy, he looks at figures that are coming out on employment, on production, on interest rates, and based on that he makes a prognosis on the development of a financial instrument, for instance stocks or currencies or commodities, etc. Now, many people ask the question, what is more important, technical analysis or fundamental analysis? Technical analysis, we're going to look at the next webinar, webinar number 5, is no doubt about it, is very important. But many beginning traders seem to think that technical analysis is the only thing that counts, that the fundamental analysis is not needed at all. This is a mistake. Matter of fact, most successful Forex traders use both. Now there's a famous quote from a very famous trader who's called Bruce Kavanagh, who said, when asked the question, what is more important, technical or fundamental analysis, he said, this is like asking a doctor whether he will be treating a patient with diagnostics or with a chart monitoring his condition. You need both. Now for me, this kind of says it all. You do need both. I can understand that nowadays technical analysis is more important for many people because it makes the analysis of the market much easier. But you should never lose track of the fundamentals of the economy or of a company when you're investing, because if you do, you're likely to end up on the losing end. Okay, so financial news has, of course, both real and speculative value. This is because on the one hand, financial news actually says something about how the economy has performed and probably will perform in the near future. On the other hand, traders also react to the news. So even though it says something about how the economy functions, how the government will probably, what kind of measures they will take in the future, there are also traders who react to the news, and this accounts for the speculative value. Speculation, because of financial news, often starts even before the news is out. Actually, one of the most famous expressions in the trading world is buy the rumor, sell the news. This is exactly because traders start speculating on what the news event might be. For instance, when the Federal Reserve is about to have a press conference in the coming days, and there is a rumor that the interest rate will probably be lowered by the central bank because of they want to stimulate the economy, for instance, then you will see that in the days leading up to the event, traders will start taking positions reflecting that probable decision, possible decision. Now, the funny thing is, of course, that when the decision is actually made and made public, and it turns out that the Fed indeed does lower the interest rate, it's quite possible that the price of the financial instrument, the price of, for instance, the euro dollar, moves in the opposite direction you would expect, because the price was already, the decision was already priced in. Everyone already thought, oh yeah, it's gonna, the euro is gonna go up because the euro dollar, because the Fed is gonna lower the interest rate. So in the days coming to it, leading up to the event, the euro indeed is going up. But then when the decision is made public, people tend to think, okay, so now we've had it, I'm going to take my profit, I'm going to get out of this market, making the euro dollar actually go down. Happens a lot. Now, it's important to realize that especially if you're a short-term trader, you should keep a watchful eye on the financial news. This is because unexpected news can hurt your positions. Imagine this: if you're a trend trader wanting to stay in a trend for years, and you're in it already for a long time, and you have a stop loss which is far away. Let's say that you're in the Australian dollar, Japanese yen, which is moving up, right? And you want to stay there, for years. Then, if the price of the currency pair drops 50 points, 50 pips, it probably doesn't really matter for you, because your stop loss is further away, because your profit target is also further away. But if you're a short-term trader, if you're an intraday trader, for instance, with a profit target of 70 pips and a stop loss of 30 pips, then news events can stop you out like that very quickly, because if a news event comes out, non-farm payrolls, American unemployment figures, interest rate decisions, consumer confidence numbers that are surprising, that say, oh, we didn't expect this, your position could easily be stopped out if it's only 30, 40, 50 pips away. So keep an eye on it, and if you don't want to deal with those particular news events, those high impact news events, simply, close your position before the event and open it after the event. Okay, so some of the high impact financial events, I already mentioned them. GDP growth is one, especially the preliminary figures. So if, once GDP growth comes out for a quarter, like the official figure, usually it's not that much different from the preliminary figures. And because of this, traders react far more to the preliminary figures than to the official end figures. So gross domestic product is important, but especially preliminary figures. Employment figures obviously are important. Mainly, I would say the non-farm payrolls. They are, by far the most important. Non-farm payrolls meaning employment figures in the United States minus the agricultural payrolls and government payrolls. So it gives you information about how the employment is developing in the U.S. By far the most important, also because of course the dollar is the most important. Dollar is, as we saw earlier in the earlier webinar, is by far the most important currency. It's present in all the 5 major currency pairs. So obviously those numbers are the most important. Interest rate decision is also very important, because central banks can directly influence the value of currency, because it's easier to borrow or harder to borrow money. Consumer confidence and consumer price index are also important. Now, obviously in the book, Forex for Ambitious Beginners, I talk about this more at length to explain the intricacies of how it works. I don't have time for that here, but if you have questions, even after reading the book, don't hesitate and find me. Okay, so quick pop quiz question. If the Federal Reserve increases the interest rate, what do you think the value of the dollar is likely to do? So the Federal Reserve says, okay, we're going to increase the rate, making it more expensive to borrow money. What do you think? That is correct. It's rising. Likely the dollar value will rise because it's more expensive to borrow money. Now, I said earlier, sometimes it's so well known that something like this is going to happen that the decision is already priced in, so that when it actually happens, the currency pair actually moves in another direction. But most of the time, this is what will happen. Quick other question. If consumer confidence in Germany declines, then the value of the euro is likely to indeed fall. Why? Well, if consumer confidence in Germany declines, that means they will probably buy less products, and domestic consumption is very important for an economy like Germany, as it is for the US economy. If people buy less stuff, producers will sell less stuff, meaning they will have to lay off maybe even more people. In any event, the price of the currency, the value of the currency, in this case the euro, will go down. Okay, trading the news is very popular with people. It's fun because important financial news can have a big short impact on a currency pair, so you can immediately get in the trade, make a splash, and get out again. So it's fun, but it's also, it comes with strings attached. You have to be very careful. Okay, so let's take a look at the non-farm payrolls in this particular chart. We have 4 instances here where the red is signifying when the non-farm payrolls come out. You can see here that in those cases there was a clear direction after the non-farm payrolls came out. Now, to be sure, it's not always like that. So one of the main things that I can tell you is that when you want to trade the news, wait for a clear direction. I would say, the whole event from publication to the dissipating of the impact of the short-term impact is about 90 minutes, 60 to 90 minutes. So I would say take a 5-minute candle chart and look at like the first 2 candles. If they are in a clear direction, you can take a position, as they are, for instance, here. This is a clear direction. Take position here. Here you can also take a position. Here I would not take a position. I mean, it doesn't mean that in this case it will be a shame, because you would have not traded that position. You would have not picked up on that short-term trend. But you want to look for those that are more likely to pay out. You don't want to trade everything. So a couple of points about trading the news. It is, of course, intraday trading, because as said, the impact of the first 90 minutes is the highest. After that, it dissipates usually. It's highly speculative, so don't expect, especially in the beginning, once you start doing it, don't expect that you will make money on every trade. You will have to take your losses with your winnings. Only open a position when seeing a clear direction. Doesn't matter which way the direction is, but you have to have a clear direction. I would say 2 5-minute candles in the same direction, and never risk more than 2% of your trading capital when trading the news. More conservative is even better, 1%, but depending on your trading capital, 1% might be a little, too little. So 2% is okay, but never more. If you have to spend 3 or 4% of your trading capital trading news, I wouldn't do it, because it's too speculative for that. Okay, so recapping: immediate effect 60 to 90 minutes, 5-minute candlesticks to gauge whether there's a clear direction. Which direction is, of course, irrelevant. Use tight stops, because if you're wrong, then you're wrong. And use trailing stops in this case, because if the direction is good, you want to pick up as much as possible. Okay, so next webinar, we're going to look at technical analysis. What is technical analysis? How does it work? And important technical indicators. I look forward to see you there. Until now, this is Jelle Peters signing off. Thank you very much.